Hi folks, and welcome to our investment banking and advisory process lecture. And we're gonna look at how senior bankers come up with ideas to advise their client. If you're an undergraduate student or an MBA student looking into careers in investment banking, this will be a great introduction lecture into that process. Also, if you're new to our YouTube channel, don't forget to subscribe. And if you like the material, give us a thumbs up, hit the notification button so that you're one of the first to receive an email alert every time we upload a lecture like this one. So with that being said, folks, let's dive right into the material. So the first thing to understand is, what is investment banking, right? I noticed, especially in our program, Romero Mentoring on the Analyst Prep side, we do get a lot of applicants that are interested in pursuing careers in investment banking. So what is investment banking? Well, for the most part, investment banking basically helps clients with strategic matter. It helps them raise equity, raise debt, and basically capital to finance their operations. But they also have different types of clients. It's not necessarily large publicly traded companies. And they also do advisory service on multiple fronts. So what we've displayed here on our screen is, on one side, their advisory services, and then on the other side we have clients that they engage with. So on the advisory side, you're engaged with mergers and acquisitions, raising capital. Should we raise equity or debt? Which one is cheaper? Which one is more expensive? Or what is the optimal capital structure of our business? They may also engage in restructuring the business. Also, bankruptcy proceedings, fairness opinion. When another company acquires a publicly traded company, bankers are typically tasked with creating an investment or a fairness opinion, where it's essentially a letter to the board saying that the price that the target company has issued us is a fair value, it's a fair price. Now, how do you come up with the fair price? Well, you perform valuation, discounted cash flow analysis, comparable company analysis, precedent transaction, and essentially is a collection of different valuation methodologies that helps them arrive to that conclusion and to issue that fairness opinion. In terms of clients, right, it's not typically corporations, whether it's public or private. They're also advise governments. They're also advise municipalities, local governments, states, districts, also hedge funds and private equity firms, insurance companies, and high worth individuals. So when you're thinking about investment banking, it's really a broad spectrum of clients and services that they're engaged in. And as we continue with the upcoming slides, you're going to see the different parts of an investment bank and what do they fall under. And of course, traditional banking, its focuses more on public and private companies, and they have their own individual specific coverage group. Okay? So the main takeaway here is to, again, understand that investment banking focuses on advising clients on strategic matters. It could, again, raising equity, raising debt, or in any other type of issues that they are faced with. And bankers is basically their role to find solutions to some of those challenges. All right? So in the next slide, we're going to take a closer look at what are the main players. So you often hear in the world of finance, you have bulge bracket banks and you also have boutique banks. In terms of bulge bracket banks, these are the top 5 or 10 investment banks that have large balance sheets. And what tends to happen is that they leverage those balance sheets to help them finance some of the transactions and the deals that senior bankers are working on. So they do have a lot more capabilities and resources to engage with larger multinational companies that do require financing and allows these mega banks to leverage their balance sheet. So in a lot of the times, that's why they're considered also bulge bracket. But then you have the boutique side of finance, which is more smaller boutique firms that don't have the large balance sheet that a large bulge bracket may have. However, they do specialize in specific advisory areas like restructuring. They might only do M&A and work on specific deals. They might also just be doing employee stock options compensations, or they might be only focused on bankruptcies, right? So boutique firms, they specialize on their own thing. And also there's a big difference in terms of culture from a large bulge bracket bank and a small boutique bank. You know, from my own experience, I started my career at Credit Suisse in mergers and acquisitions. And one of the interesting things with being in M&A at a large bulge bracket bank is the scope and the size of the group. M&A is a product group. We were basically the largest group within investment banking. We had a lot more resources, and we also had additional help from some of the night staff that would help us format our presentations, that will help us spread comps. So these are some of the resources available to first-year analysts to help them juggle and manage multiple projects simultaneously. At a boutique firm, however, you may not have those resources, but on the other side of the spectrum here, you might have to be more resourceful yourself, and you might also be more engaged with senior level bankers, where you might be giving a lot more responsibilities when you are dealing in a transaction. So it could be also a very fruitful learning experience. It's your job to know and learn more about that company's culture, whether it is a bulge bracket bank or whether it's a boutique bank. And you always hear, the benefits and also disadvantages from a large bank and a small boutique bank. I always like to tell students in our program is focus more on your own personal preference. What's your personality? What type of environment are you more engaged in and you want to learn more from? If you want the boutique bank, then you know that you're probably going to be giving a lot of responsibility and also working directly with senior banker. It may probably be a less formal culture within that organization. But if you like the large mega banks because of the resourcefulness, the ability to work on larger transaction, that might also be another route for you. But do your own homework, answer your own questions. Why do you want to work at this specific bank versus another bank? Is it the culture? Is it the balance sheet? Is it the reputation? Is it the specific deals that they're working on? These are questions that are going to be asked as you're going through your own interview process, but you should have as well good answers to those questions like I just mentioned right here. So with a pen and paper, just write it down and really internalize your reasons for why you want to work at that specific firm. So that's the main takeaway from this specific slide. And one last point that I'll address is this here at the bottom to really give you the magnitude of the level of impact it has in not only in finance, but in the overall economy. The top 10 banks employ approximately 1.3 million workforce, right? You can say that that's basically their size of the workforce. And we're talking about primarily here the bulge bracket bank. So it's a pretty deep industry with a lot of resources and a big workforce as you're seeing right here. Okay. Now, in the next slide, we're going to focus more on the actual groups and how investment bank is traditionally broken down to. So, banking is traditionally broken into two parts. You have the corporate finance, which is investment banking, and then you have the capital market side, which focuses more with providing liquidity, sales, and trading. In terms of corporate finance, the principal business is really to win new advisory service business from clients. And when you're looking at the specific groups in there, as I'm displaying here on the screen, you have mergers and acquisitions, as I've mentioned earlier, is typically the largest group within investment banking. You also have your coverage group, traditionally media, technology, telecom, industrial, retail, where you have a designated group with managing directors that have relationships with largely traded publicly companies, and they would typically pitch them ideas on how to improve the overall business and how to find financing to grow and execute on their business plan. Then you have financial sponsors, which typically engage or work more with private equity firms that are looking to secure financing to execute their leveraged buyout deals. If you're not familiar what a leveraged buyout is, it's essentially a group of sponsors or a private equity firms that would raise capital and buys a company, putting equity up, but they're also raising debt either from a bank or a hedge fund that provides financing, and they are using the company's cash flow to pay down that debt. Another way to really think about it is from the standpoint of buying a home, right? When you buy a house, you put down 20%. That is your equity. And the bank lends you 80% in a form of a mortgage. And over time, you service that mortgage. You could rent the house and the rental income is used to pay down the mortgage. Well, it's a similar concept with a business. You put up a small amount of equity, the bank lends you money, and then the cash flows of the business pays down that debt. You're servicing the debt. And over time, the debt declines, your equity increases, and your return on investment also increases from that level of financial engineering. So that's pretty much what financial sponsors deal mostly with. Then you have another group known as restructuring. And restructuring focuses on bankruptcies, improving the balance sheet, when a company is either downsizing and they are eliminating weak performing businesses, they want to sell one of their segments. How much should we sell that segment for? What is the value of that segment? Who is a good financial or strategic buyer of that segment that we're trying to sell to get our business to be more lean as we're going through this restructuring process? This is the level of advisory that also investment bankers in the restructuring group would pay attention to and also focus and advise clients on that specific matter. So notice that that's very niche and very specific versus raising debt or raising equity or even doing an IPO. Very specific. And of course, you also have your middle market group. And middle market group focuses on smaller companies that might be private. Someday they might be looking to do an IPO, or maybe they might want to sell. The founder of those businesses may want to sell to either a public company or to a financial sponsor. And the middle market bankers would formalize the relationship with the senior level management of the team or even the founder and the CEO, and then they would advise him on that process depending on what the client wants to do. The second part of investment banking, as I've mentioned before, was capital market. And capital market focuses more on providing liquidity, not only to their clients, but also to the overall markets. And under capital market, you might find desks and teams revolving around equity and fixed income, which primarily focuses on raising capital directly from investors. They're engaged in the IPO process and also bond offerings. You have syndicate groups, and syndicate groups essentially provide loans and line of credits also to clients. And in the example of an IPO process, if XYZ company is issuing shares for the first time, the syndicate group will collect the bids from hedge funds, pension funds, even mutual funds that want to buy the shares before they are publicly listed. And that syndicate group basically takes in all of the orders before those shares are open and basically are freely available to trade on the open market, where you yourself might buy and sell these shares, or I myself might be engaged in even trading those company shares. So the syndicate group may provide financing, that might buy those shares directly, or they might raise or take the orders from the pension funds or other sophisticated financial investors that want to participate in that IPO process. Then you have another group which is known as equity linked desk or capital markets. Primarily works with clients to issue specialized financial products. Here's an example. If you are a client and you're looking to get exposure to the overall NASDAQ, but you want to extrapolate a few companies from there, an equity linked desk might be able to do that for you. Okay. And also here, when you see the next group here, structured finance provides structured transactions, lease, sell back, that's a little bit different, but they both kind of provide similar advisory or solutions to clients that might want to do that. I remember, my sophomore year in college, when I was an intern at Bank of America, I actually got to sit with one of the equity links trader, and he was explaining me this process where if a hedge fund manager wanted to be part of the Dow Jones Industrial Average, but he wanted to remove 5 companies from the Dow Jones Industrial Average, then the equity link trader would basically create that structured product, and in exchange they will collect a fee. So that hedge fund manager would have access through that new product on the Dow Jones Industrial Average, but remove 5 companies, not having exposure to maybe the 5 weak performing companies, so that the Dow Jones Industrial Average, which consists of 30 stocks, will now only show 25 stocks, and that will be his own specific index that he can trade or add to his fund just to capture significant upside and not have any down performance or drag from those 5 companies that they excluded. So it's a pretty unique product that these types of trading desks provide to the buy side clients or any other type of sophisticated investor. So that's pretty much on the equity link and structure side. Then you have high yield capital markets, as you can see right here, works primarily with companies that want to issue high yield debt, or if you want to refer it as junk bonds, which is higher risk than investment grade bonds. And what you may have is hedge funds that actually invest only on high yield bonds. Then they'll deal directly with that specific desk. They'll get them a quote, they'll mix and match whatever they may have on their inventory or maybe with other sellers with those buyers of junk bonds. So very specific desk. And if you are someone interested in bond and restructuring, maybe high yield capital market desk might be an interest for you. If you're someone that likes to learn more about the mergers and acquisitions process, what do CEOs think about before they acquire a business and how bankers play a role in that M&A process, then maybe a mergers and acquisitions group could be a good opportunity for you to enter. But as you're thinking about this, make sure that you have your why. Why do you want to be part of an M&A group? Why do you want to be part of the high yield desk? You need to have very specific technical reasons and also qualitative reasons for why you want to do it. Is it because of the skill set that you're going to develop? Is it going to be because of the people that you're going to be working with? Very smart individuals that also understand very complex problems and find solutions to them. You may also do it because of the amount of learning about the industry and the client challenges. If you're someone that likes capital markets and the volatility, then with high yield, you should have an understanding of bond pricing, and it's something that should just fascinate you. And if that's the case, you should be doing your own bond pricing yourself. You should go ahead on Google and research, how do you price a bond? How does interest rates impact the overall bond market? What happens when interest rates go up by the central bank? Do bond yields increase or decrease? What happens if interest rates decline? Do bond yields increase or decrease? And also, how does it impact companies' ability to generate cash flow and service those bonds, which ultimately impact those high yields? So this is more on the technical side that you can start to learn more on yourself. Take the initiative so that when you have those interviews, you can ask those very technical questions and just show that no one had to tell you this. You took your own initiative because you are genuinely interested in the topic. Therefore, you are learning it on your own. So you have to also be independent when it comes to that. So I hope this gives you a broader understanding of the two sides of investment banking. One is corporate finance, which focuses more on the advisory side. The other one is on the capital market side, which is more related to desk and working with buy-side clients, okay? Now, the next slide is gonna actually give you more of a broader view on how we separate the banking side with the capital market side and other businesses that might be part of a large bulge bracket bank. So here you're seeing on the left-hand side, okay, you have your investment bank, okay, and then within investment bank you have your coverage group. Some of these coverage groups could be healthcare, energy and power, chemicals, which is also part of your industrial sector, financial sponsors, banking, insurance, real estate, middle market, industrial company, etc. So if you're someone that is an undergraduate student and you want to do investment banking, one of the reasons, or actually one of the questions during the interview process, if you get the internship, which group do you want to work for? And of course, every one of these groups has its advantages and disadvantages for why you may want to work in one of them. But one of the unique things about being a coverage banker is that you get to learn the industry specifics. What is the industry margins? How does the market typically price these companies on a sales, EBITDA, and PE multiple basis? What is the consumer trend that it's emerging in that specific industry? What is the economic cycle for that industry, right? You have economic expansion and then contraction. How does that industry behave during that process? You might also be very involved in IPOs within that specific industry. So you do get to develop a lot of knowledge in industry specific terms when you are in a coverage group. Now you go to the product groups. And that's the second one right here, under investment banking. And within product groups, you have mergers and acquisitions, leveraged finance, restructuring, and all the other ones that I've listed here. One of my reasons for doing investment banking and being part of the M&A group was because of the modeling and the technical skills that I was going to develop. Within investment banking in M&A, we were very well known for our technical abilities to develop very complex model from an M&A standpoint. Here's an example. If company A wants to acquire company B, what would the merger look like after the transaction? What would be the acquiring company new capital structure? And another question that we would answer is, would the deal be accretive or dilutive? In simpler terms, would the shareholders of the acquiring company, would they get a return on their money? Would the earnings per share be higher or lower post-transactions, therefore generating some sense of return on that acquisition? Other things were, what type of synergies can we realize? What are some strategic matters? Is it because they want to enter a new market? Is it because they want to increase their market share, acquire new technology? So these are things that you begin to learn when you are an M&A analyst. And these were some of the reasons why I decided to pursue investment banking. And I was fortunate and lucky enough to have done mergers and acquisitions at Credit Suisse. But it's your job, if you want to be part of any one of these other product groups, to know those specific reasons why you want to be part of that group, okay? Then after that, you have corporate finance, which is another product group, but this again relates a little bit more to the banking desk on capital markets. Like I've mentioned in the previous slides, you have equities, equity links, high yield, syndicate. And these desks, they serve as a way to providing additional services to clients. For example, if you're advising a multinational company like a McDonald's or Nike, they do have exposure to foreign exchange and currency risk. So as a senior banker or managing director, you might be advising them on raising debt or maybe raising equity for their share buyback program or to finance expansion. But you might also say, hey, look, I noticed that 40% of your business comes from the international market. Therefore, you have foreign exchange risk. I know our guy, which is on one of our syndicate or in our FX desk, who can actually give you favorable terms to lock in the current exchange rate, because we believe there's going to be a decrease or increase on this currency, which might save you 10 or 20% of your profits, which would impact your earnings. Therefore, your shareholders will benefit from that. So that's more of that thinking process that you can advise your client on additional service and then match them with the right desk or the right person within investment bank to continue further that idea. All right. Now, separate from your investment banking, you have trading and investment. Again, this also falls under capital markets. There's a difference between the investment banking side and your trading and investment side as well. Notice that I have here a dotted line. And this is supposed to be a Chinese wall, an invisible wall between investment banking, which advise their client, and research and trading. The reason why we have this invisible wall, this is actually also due to regulation, because in the 80s and in the 90s, you have investment bankers that would essentially tell clients that, look, if you give us the business, we'll tell our people in equity research to write favorable reports. Now, these reports would be biased. They will be in favor of the company. These will not be independent reports. And when you have the buy side, when you have capital markets and investors making decisions around those research reports, you know it's basically perhaps unethical, and there is a conflict of interest in there. Are you writing these reports because you are looking after the investor, or are you writing the research report because you're looking out for the client on the investment banking side so that they can win the business and get additional transaction fees? So regulators became aware of this. FINRA basically started regulating that, where now you cannot have that. I recall my time when I was a banker. If I needed to speak to someone in equity research or in capital markets, we needed to go through the legal process within the firm. We had to reach out to someone in our operations department, and one of their someone from the legal team would have to listen to the call to make sure that there was no conflict of interest, and any type of questions or request was not unreasonable that would put the deal, the bank in jeopardy. So this is the type of regulation that you're seeing between investment banking, sales, and trading. Now, within sales and trading, you have all these other type of desks where they might be buying shares for clients on the buy side, hedge funds, mutual funds, or sometimes if a company has a share buyback program, that share buyback program might be executed within the bank with the equity traders that make a market in that company's stock. So that's another way where banking and sales and trading do kind of combine. There is similarities between both of them, and they actually do get to work together. Then you have other things, like I've mentioned before, your research arm, where you have research analysts writing research reports on specific company stocks. It could also be on the bond side. It could also be on any other type of asset, like we've seen right here. It could be credit. It could be commodities, currencies, high yield, the economy. Okay, so if you're someone that likes research, if you're like someone that likes data and formulating your opinion and writing about it, maybe the investment banking or the investment research side of an investment bank might be something that might interest you, and perhaps you may want to pursue a career in that specific area. Then you have other groups like proprietary trading, where they're taking on trades on behalf of the bank, leveraging the bank's balance sheet. You have private equity and merchant banking, and also risk management. Each one of these divisions that you see here, and each one of these specific desks, right? So you have to look at the division, and within the division, there's individual desks. These desks, they're run like their own actual business. They might take positions using the bank's balance sheet to generate their own profits on any type of investments that they may make. And then at the end of the year, how much did our desk generated in terms of business? And of course, the people that are working on that desk would receive a bonus. But every single group that you're seeing here, it's a small little business within the organization that is really part of a larger system of within the investment bank. So this is more trading and investing. Then you have the other side of the business up here. And the other side of the business, this focuses more with larger banks. They have the commercial side of banks, and they also have the investment banking and capital market division. Think of about a JP Morgan. They have the advisory investment bank, and they also have their retail commercial bank. Think about Bank of America Merrill Lynch. They have their retail side of the bank that collects customers' deposit. They also work in helping you finance your first home by giving you a mortgage. And then they have the investment banking side and capital market side of things to advise corporations, high net worth individuals, also municipalities, government agencies, etc. So part of that system, or part of that banking business, you have private banking, investment management, commercial banking, consumer banking, retail brokerage, mortgage banking, insurance, and other. Each one of these blocks that I've mentioned right here, it's its own business under the retail side of the large bank. Not on the investment banking side, but on the retail side of the business. So I think this slide really gives you a more holistic view, but specific structures within the bank that have their own specific groups that operate as its own individual business within a larger bank that allows them to communicate with one another, with the exception of the Chinese wall within equity research, but can provide more services to their client. Now, with a boutique bank, this may not be the case. It might be obviously a smaller organization that focuses on a specific level of advisory service. Again, like only IPO, maybe restructuring, mergers and acquisitions. And again, they might have their own advantages because of the level of expertise. The senior team may have a lot of experience and have worked on very complex deals, and may have also built a lot of relationship over a 10, 15, or 20-year career within investment banking. So I hope this gives you a better picture and understanding of the different parts of a bank, the groups within those firms, and also different career opportunities in each and every one of these sections within a large investment bank, okay? Now, in the next slide, we're gonna take a closer look here at some of the size of these banks from a revenue standpoint and also from the workforce standpoint. In earlier slides, we talked about that about 1.3 million people work within the large top 10 investment banks, and here they are. Whereas Fargo, if we rank this from highest number of employees to lowest, Wells Fargo is at the top of the list. In terms of labor force, 261,000 individuals are working for Wells Fargo. And assuming that the bulk of the labor force is really concentrated on the retail side of the business. Commercial banking, collecting consumers' deposits, dealing with their savings account, also helping them with financing their homes through a mortgage, etc. So you could see that. So the retail side of banking might probably require a lot more individuals to service the retail side of the bank. Now, all the way at the bottom here, you have Goldman Sachs with 37.8 thousand employees or labor force. And obviously Goldman Sachs focuses more on investment banking services for corporate clients, governments, municipalities, and also high worth network individuals. And this is quite interesting. Another thing that I included here was revenue. Okay, you can see here JP Morgan has the highest revenue within the industry. And this is as of November 16, 2019. Okay, they had, from their most recent annual report, 107 billion in revenue. And in terms of equity value of the business, wow, almost $500 billion, 403 billion. So this gives you a better understanding of the size, the scope, the magnitude of these banks. And this is specific information that, if you're an undergraduate student or MBA student interviewing at these organizations, this is information that you should know. Because someone may ask you, why do you want to work at this bank? You should have very specific reasons in bullet point format. Reputation, number of deals, leveraging the balance sheet, cross-border transaction, working with very smart people. And again, you can keep going down the line in having really good structure answers and reasons specific to that bank of why you want to work there. Okay, so I thought this is a good, interesting slide that I may want to throw in there to give you more information on the top 10 banks, how big they are, their labor force, and what is the size of their scope, not only from the labor side, but also but revenue and their capital structure of the business. Okay, now, in terms of the career path or the hierarchy in traditional banking, you can see that at the bottom, you have the analysts. And traditionally, analysts are recruited directly from these firms' internship programs or directly from undergrad, just going through the interview process. And once you are within a firm, then you could move up to the associate level, then VP and managing director level. You can see here, we included hiring pool, where traditionally they're coming from, and also what is their term. How long are they spending in that position before they get promoted to the next level and then the next level after that. For the purpose of advisory process, we're going to focus on managing directors, okay, where they're the ones mainly responsible for coming up with creative ideas, presenting to clients, and maintaining that relationship. So in the next slide, you're going to see here a little bit more about the responsibilities of a managing director. Remember in the previous slides, I mentioned that you have to think of investment banking specific group as its own individual business. So let's say you and I are managing directors. What will be our responsibilities within the, let's say, the technology group? Our job would be, number one, to win new business, build new relationships, and pitch them ideas on how they can improve their business or help them execute their longer term business plan. Also, we have to maintain these relationships as well. We also have to make critical decisions on how we have to grow our group and allocate budget and being part of the hiring pool, because again, you are running your own business, your own group within a larger bank. Another thing, of course, is presenting the materials, the presentations, the pitch book that you're putting together. Is your job and responsibility to walk the client through that and understand the thought process and explain it to them. Okay? Also, negotiating transaction agreements, ensuring that the firm's resources are used appropriately for each deal. What does this mean? How many analysts, associate, or VPs do we need on this merger transaction? Am I going to take someone from my technology group, or do I need an M&A analyst? If that's the case, I would reach out to the staffing individual, the person in charge of staffing in the M&A group, and say, hey, John, I am looking at creating a preliminary analysis pitch book for my client on the possibility of them acquiring this small tech firm. I need an analyst that can create a merger model and also run multiple scenarios. Can you staff me someone from your group? The staffer will say, sure, let me see who's available. Let me get some capacity. I found Luis. Hey, Luis, here's a new project staffing. Talk to the VP on the technology group, who is also part of the team, and he would inform you and give you the details of the pitch book or this particular project. Then I will speak with the VP. I will understand what they're trying to do. I will understand my role in the entire process, and then I will start putting together the M&A model. I might work directly with the analyst within the technology group that is also staff. I may ask that analyst for his comps so that I can do some preliminary valuation analysis. If he has built a model on the target company, I may ask him for that model. If not, I would just build my model from scratch. And then I would build a merger model integrating both companies to determine what would be the accretion dilution. We will put together a pitch book. We will show it to the managing director. And then the managing director will go through it. He would add his own perspective, his opinion. He might say, add more information, remove this information, show me this level of analysis because I want to explain it to the client. And that's would be my process basically, is to improve the presentation and turn the comments received from the managing director or even from the VP if the managing director is talking directly with the VP. So how do you think more carefully about strategic matters, right? Where do managing directors come up with these ideas to present to clients? Well, in the next slide, you're going to be able to see that strategic advice includes creative ideas to help clients find solutions. So what does this mean? Well, you want to focus on specific areas. And I laid out in this slide several challenges that sometimes CEOs are faced with, but because they don't have the technical background like an investment banker, need help in helping them understand these things. And what are they? And by the way, this is what senior bankers are constantly thinking about to improve the relationship with their clients, continue to pitch them new ideas, and also show them that, hey, I'm here for you. I know what your long-term goal is. I know you want to grow your business. I read your business plan, your shareholder letter. I think that we can create a good presentation to help you achieve that. I'm part of your team. I'm here to support you and listen to you. Now, the really good bankers, they take it a step further. They become they build close relationship with those clients to essentially calm them down in situations in situations of high stress. They might perhaps underperform in a quarter. They might be up for compensation review with the board. My job as a banker is to make sure that they have all of the resources that they need to help them achieve their mission, their goal, and their plan, and also to give them ideas that they're probably not thinking about because they're more concerned with running their business, the day-to-day operation, not on the financing side of things, not on the complex models that bankers are known for putting together. So here's what are some of the things that senior bankers are thinking about. You have capital structure on the first bullet. So we will look at the company balance sheet, and then we will say, look, is your balance sheet capitalized in line with the industry? What is the average company in your industry have in terms of debt? Is it 20% debt, 80% equity? Is it 60% equity, 40% debt? If your company perhaps is not in line with that industry capital structure, that's an opportunity for you to perhaps get it a little bit more in line, and that might mean issuing more debt. And then what are you going to do with the cash that you receive from collecting or issuing the debt? Are you going to buy back your own shares, which right now has been a hot topic in many political circles and also for discussion? Are you going to use the proceeds to acquire another business, enter a new market, and grow your overall footprint and your market share and revenue and all of the other benefits that come from engaging in M&A? Are you going to improve your infrastructure? Are you going to expand and invest more heavily in CapEx? So there's different ways of using the proceeds from raising debt that will get your company in line with the industry capital structure, which might improve your company's valuation. And that leads me to the second bullet point here, valuation. Is your company stock being fairly valued by the market? Now, the CEO may not understand that process, but the investment banker, the senior one, is his job to understand this. If your stock is underperforming, why is that? How is the public market? How are investors perceiving your stock? What is the story? And then put together a nice presentation to help the CEO, the senior management, and the board understand why their stock is being undervalued, or is why it's being underperformed by the overall market. Is it operational issues that your business has? Is it lower margins than its competitors? Is it lower growth profile? Or is it the level of debt that you may have on the balance sheet? Then what can you do to improve your overall valuation and the perceptions from clients? Then that's where the bankers have to come up with creative ideas, put together a presentation, do the technical modeling that involves doing all of this type of analysis so that you can present it to the client and then show them on a pro forma basis what would happen if we engage in share buyback, in acquiring this business, improving our margins by 5 or 7, 8 basis points or even percentage terms, what would happen to overall cash flows. So these are the technical skills that you need to possess in order to run your analysis and then present it to a client from an objective and technical manner. And I'm going to show you, I'm going to give you some of those examples on things that we've done within my own advisory firm and also my own fund, Romero Capital, but also what some of our analysts in our program have put together from an advisory standpoint to better understand this process. So I'm going to give you more examples. The third bullet point that I have listed right here is mergers and acquisitions. Some of the questions that we're answering for the client is, should we acquire or merge with XYZ company? What would be our pro forma analysis from a mergers and acquisition standpoint? In other words, what do we pay attention to? Accretion, dilution. Will our shares, earnings per share, is it going to be higher or lower after the transaction? Let's do that analysis. What would be our margins? Our gross profit margins, our EBITDA margins, our net income margins post-transaction. Is it going to be higher or lower? What would be our new capital structure? Are we going to have more debt on our balance sheet? How are we going to finance this transaction? What will be the consideration? 60% equity, 40% debt, or are we just going to finance this 100% cash? What would be our PE multiple for issuing shares? Okay, how expensive might the deal be? Also, other questions might be, what would be our synergies for this transaction? How much synergies can we realize? So these are the type of questions that are asked during an M&A process, and then the analyst would do the model, all of the high-level detail modeling to just give us the answers to these questions on a preliminary basis to come up with decisions and then see if we can actually execute this transaction. And of course, the bankers will get their advisory fee from executing and doing the whole due diligence and sourcing and managing that entire transaction, okay? Then you have other things like share buyback. How can we finance a share buyback program? Well, you can finance that by issuing debt, okay? How much debt are you gonna issue? What would be the cost on the debt? How much interest are you gonna pay on that, right? So that is all part of the advisory service, that if a client has that question, we have to be able to answer it. We have to be able to run the scenario. And also, if we buy back our own shares, by how much will our stock price increase? That is part of the analysis that investment bankers would put together, that the managing director would explain to those clients. Other matters would include foreign exchange risk, hedging risk, IPO process, maybe selling one of their business, finding the right financier from the buy side, if it's a hedge fund or a private equity firm that only specializes or invests in specific deals or transactions. Again, it's part of the job within the investment banking group, the senior bankers, matching buyers and sellers of businesses and companies. So this is more of that advisory process that we were alluding to earlier. But what does the final product looks like? In terms of a product, it's really about the presentation and what information we are relying to our clients. So here's an example of that. Let's pull up a presentation put together by one of our students in our analyst program. And here we are starting with comparable company analysis. When you're looking at the steps, if you're new to this, especially for those of you that are looking to enter investment banking and you want to become an analyst, if you're an MBA student and you are going to enter as an associate, one of the things you should be training your mind is looking and studying comparable company analysis and focusing or paying close attention to capital structure, okay? Margins of the entire industry, and also your multiples. Because it's your job to help clients understand how the market is valuing your company. Are you being treated as best of breed, therefore giving you a premium? Are you being treated as a lower tier company, therefore giving you a discount and you're trading below the industry averages? So the first thing you want to do is look at the capital structure of the business, right? You can see here that for TJ Maxx, at the time that we did this, TJ Maxx debt levels was 3.1%, whereas the equity side was 96.9%. So 3% debt, 97% equity. Look at the industry average for similar companies, retail, brick and mortar, mega stores. See here? About, if we round this off, let's say 30% debt, and on the other part, 62 or 63% equity. Do you see that from a balance sheet standpoint, TJ Maxx could issue debt to get their balance sheet more in line with the industry? And what would they do with the proceeds of issuing debt? One of the recommendations that was provided by this analyst was to buy back shares. So how much shares can we issue how many shares can we buy back, I should say, and how much debt can we issue to get us more in line with the industry? So this is part of analysis that you can do in your own model. And here's what he came up with. The next slide shows some of that, some of the advantages of share buyback, things to consider, and also if they decide to engage in M&A. But to bring their capital structure more in line with the industry, it means that they would need to increase or raise $20 billion of debt that would allow them to buy back 263 million shares, okay? So to get your capital structure in line with the industry, issued $20 billion worth of bonds, and with those proceeds, go back and buy shares. How many shares can you buy? Give or take where your stock price is trading at right now, you could buy approximately 263 million shares. Now, if you buy back those shares, what does that mean? It means that your earnings per share will increase, because as your net income increase, which is the numerator part, your denominator would be your shares outstanding. As the denominator shrinks, your earnings per share will be higher. It's a form of financial engineering. And if you apply a multiple to your new earnings per share, chances are that your stock price will be much higher on a pro forma basis. That's the level of preliminary analysis that we would create. Then you would do another slide illustrating the capital structure of the business. So on a standalone basis, you see here on the left, you have the level of equity of the business, 50.1 billion. Then you had the total debt side. At the time that the analysts put this together, they had 1.6 billion worth of debt, 97% equity, 3% debt, and would bring their total capitalization to 51.8 billion. Okay, we understand that. On a pro forma basis, what would be the new capital structure and what would be the new capitalization of the business? Well, equity will still stay the same. But in terms of debt, here it is. You add the 20 billion in debt that we discussed would bring their total debt number to 21.6 billion, bringing their debt side to 30% and the equity side to 70%. Now look at the new capitalization. It's increased by the amount of debt that they're going to issue. And this other pro forma analysis here is just in how long can they pay down the debt. Another question is, can we handle that level of debt? Well, yeah. Total debt issue, there it is. Okay, this is a new debt issue as well. Then take a look at their EBITDA, 4.3. If you take a look at free cash flow or cash available to service debt, they were generating enough capital to service that debt. And if you look at credit ratios, which is another way of looking at how long it will take the business to pay down the debt, total debt over EBITDA, if you just look at EBITDA, about 5 years. If you take a more narrow number, which will be total debt minus EBITDA and CapEx, you can see that it will take them approximately 6 to 6.5 years to pay down that $20 billion if they used 100% of their free cash flow to service that debt or cash available to service debt. If they use 100% of that, it would take them approximately 6 years to pay down that $20 billion. But of course, they're not going to pay that in 6 years. The $20 billion worth of debt will be issued in a form of a bond, and that bond will probably have a 10, 15, or 20-year maturity depending on what the capital market is pricing. Then you will get the people on the bond desk, and they will give their opinion how much they would charge for that level of pricing. What is the market? What are investors paying for that level of debt, giving the financial profile of TJ Maxx? So all of this analysis will be done by the investment banking team to present to TJ Maxx, okay? And all of that is just by looking at the capital structure. So that's number one. The second thing would be, if we scroll back up, the second thing would be is to look at your company's margins, right? Here it is. And margins is just another level of how profitable your business is. For every dollar of revenue that comes in, how much do you get to keep in gross profit, in EBITDA, net income, EBIT, etc., right? So what was TJ Maxx gross profit compared to the industry? Well, here it is, 28.9, whereas the industry average is between 36 and 34. What about on an EBITDA basis? You can see here, 13.9% versus 12%. So operationally, we can say they're a little bit more efficient than the industry average. What about an EBIT basis, operating income? 11.9 versus 8% really. I mean, he could have added an additional decimal place so that we can see what is that remainder decimal place. But if we just round, we'll get 8%. Now, from an advisory standpoint, we can say, yes, you are running your business a lot more efficiently than the entire industry peer group, which means you're generating more cash flow. For every dollar of revenue that you generate, you get to actually keep more cash than everybody else in the industry, or higher than the average. So if you do finance and you get to raise debt, you can actually pay down that debt without giving any type of valuation by the market. And maybe you can use part of that 20 billion, not only just to buy back your shares, but maybe to remodernize some of your stores, maybe to improve or invest the technology side of the business to give you more margins, right? You're leveraging your operations. And there's so many other things that we can do with that capital that would allow you to expand and outperform your peers. So this, again, this is part of the thought process, and then you have to polish that story and have the right analysis to present to the client. Okay, so again, this is all about being creative, and I'm just giving you something that is very methodical, using financial data to come up with these ideas. The other thing you may want to look at is the trading multiples, sales, EBITDA, and PE multiples, right? From a sales standpoint, 1.6 versus, let's say 0.7. They're trading at a premium. Look at EBITDA, 11.4 versus, let's just say 6.5. They're also trading at a premium. Some investors might say that they're expensive. Other investors might say, no, the market's actually rewarding them because they are one of the best companies in this industry group. They might also be growing faster than everyone else. Therefore, they do deserve a premium. In addition to that, look at the PE, right? Trading above the industry average. So these numbers could be interpreted in many different ways. But of course, if I'm on the sell side, if I was in investment banking advising clients, I would not say, hey, look, you're overvalued. No, of course not. Because then the client might say, what kind of banker are you telling that my business is overvalued? Right? You have to put yourself in the shoes of the CEO and the person that is going to be receiving the information. How are they going to react to what you're telling them? So my story around this would be that you are operating better than everyone else. You've definitely done a great job. Your business strategy is working. Therefore, the market is rewarding you for your level of operating efficiency. So with that, if you raise $20 billion through a bond offering, you can use that money to really distance yourself from everyone in the industry, because that capital will be used in improving your technology, your infrastructure, buying back your own shares, and returning capital to your shareholders. I believe that the market would reward you, and then we will have the analysis that will showcase and strengthen that argument that I'm making, and also that advice. It's all about finding the information that would validate the advice that you're giving that client. So this is just a very simplistic process where you can apply your technical skills in being able to give this advice to a client. And I'm sharing this with you so that for those of you that want to pursue investment banking, you should be doing this right after finishing this lecture. Go ahead and spread comps. If you don't know how to spread comps, just take this information directly from Yahoo Finance. Look at the capital structure. See if there's room for the business to issue debt. And if they issue debt, what can they do with the proceeds of issuing that debt? Should they emerge in mergers and acquisitions? Should they buy back their own shares? Should they issue a dividend? So there's endless possibilities that you can come up with as long as you're creative about it. So I think this is a good example to introduce you to that advisory process. Now let me show you another example that's a little bit more complex, and this was actually more from my fund, Romero Capital, from a shareholder standpoint. So now we're transitioning from the sell side, what a senior banker would provide, to an activist investor. If I own shares in a company and I understand that the CEO of the business doesn't have an investment banking background, he doesn't have the technical skills to understand how the market is valuing their company, because they're just, a genuine entrepreneur, excellent at running the business and business development, but when it comes to the technicals of modeling and corporate finance, they may not have that background, and that's okay. But it's my job as a shareholder to voice my opinion, give them advice on how they can potentially improve the business, which would put our interests, it would align them together. So what does that look like? Here. So we actually put this together for Symmetric, which was a small middle market industrial company. They had two segments of operations, and through the due diligence process, we learned that one of their segments was less profitable than the other. And because of that, the market was actually undervaluing the business. So here's the first step. Look at the capital structure by spreading comps. And remember I said this business had two segments. So we spread comps for each segment. So they had their electrical equipment and diversified segment, and they have their environmental and disposable segment. Look at the capital structure, okay? So for one area of the business, other competitors, capital structure on the debt side, we can take the midpoint here. Let's just say 15% debt and 85% give or take on the equity side, all right? Look at the margins, okay, double-digit margins. Look at the multiples, especially on an EBITDA level, right? 15 to 16 on a PE, 34 to 36, so double-digit multiples. So this segment, double-digit margins, capital structure, 15% debt, 85% equity, and the market was paying double-digit multiples for these type of businesses, electrical and equipment diversified. Then their other business was the environmental and disposable business. Look at the capital structure for similar business in that industry. Has a little bit more debt, right? You see that? So you could say, we could round down, let's say 30% debt, 70% equity. Okay. Look at the margins, the profitability of environmental disposable businesses. Single digit EBITDA and 11% on EBIT, and then in the low 20s for gross profit margin. So the environmental and disposable segment is less profitable. These type of businesses are less profitable than electrical and equipment diversified businesses, okay? Now look at the multiple. Look what the market is paying for environmental and disposable businesses. On a sales basis, single digits. On an EBITDA basis, single digits. On a PE basis, okay, double digits, but it's still lower than their electrical equipment business. You see that? Now, when you actually look at the target company, Cementrix right here, look at their capital structure. It's more in line with their environmental business. The capital structure is more in line with that. Look at the margins. It's also more in line with the environmental business. And then look at the multiples. Very, very low. Well below the industry average. So from an advisory standpoint, from a concerned shareholder, we ended up putting this entire presentation, and we understood the story for the reasons why the company was being undervalued by the market. One of the things we also learned was that when the company provided their financial statement, it was all on a consolidated basis. They did not break apart each business. They did not provide individual financial statements for each one of those businesses. We had to actually figure this out ourselves through the due diligence process. So one was consolidated financials. We recommended them to split the business and provide more transparent, detailed financials on each business so that investors can do this level of analysis. So that was one of the recommendations. The second recommendation was, look, why don't you sell your environmental and disposable business? Sell that business. And the proceeds that you receive from selling this business, buy back your own shares, reduce leverage, and focus on investing on the electrical equipment business because it's more profitable and the market gives that business a higher premium, okay? And finally, the other idea that we ended up advising them was to focus a little bit more on transparency and adding new members to the board. Members of the board that were more experienced in the electrical and equipment business and actually growing and expanding them into multi-billion-dollar organizations. The reason why we advised and recommended that was because of the background story on how Cementrix was actually founded. The company had a very young CEO, and the CEO came to that position through the main backer or the main investor in this business, which is a billionaire that funded the acquisition of a small business, and he actually put in place his son to become the CEO, and through that process then they went ahead and acquired another business. So it was a business that was increasing through acquisition, not organically, and the CEO was put in place actually by the father who financed this entire transaction. You can see why it can be a concern to public shareholders. As a hedge fund manager, if I'm looking at this, I won't feel confident or comfortable with millions of dollars on the line invested in this business when I already know that the CEO might probably not be the best person for the job if he didn't earn it or has years of experience in growing and transforming business. So that might be a little conflict of interest, and that's how other investors might be perceiving that. So that's one of the things that you have to be able to explain and tell a story where it's not coming across as perhaps an attack. It's not coming across in a way that might be detrimental or putting or shading light on the inexperience of the CEO, right? You have to be very tactful and methodical on how you deliver a message that comes from a constructive perspective where you're trying to improve the business, where both of our interests are nicely aligned. So this was more of our thought process when we put this together. And then this entire presentation really revolves around showing the competition, understanding the industry, the market, understanding areas of the business that they can improve on so that they can send a message to the overall market and other investors that they hear them loud and clear. And we're going to execute on improving their margins. So if they were to execute on all of those advice that we recommend them, then where can the stock price had increased? So that requires some level of preliminary analysis that is very technical. Now, what does that look like here? So let's show that in our screen. Let's move up. Here it is, okay? So one of the things was also to focus on improving margins and focusing on their most profitable business. If they did that, they could have taken their stock price from $2.86, based on our analysis, based on our projection, based on the multiple that the market would pay this business, we anticipated that the stock price could increase to $11. That's a 284% upside. Then when you look at the entire firm value, enterprise value, you take debt and equity, they would have taken their business from 28.5 million to approximately 112 million. And then we have other sensitivity analysis that shows by every incremental increase in margin improvement and in revenue growth, what would be the implied share value and stock price for this business? So again, this requires a little bit more technical analysis that you can apply to show the board of directors and the CEO, the senior management team on the potential return on investment and also the return to their shareholders if they perhaps execute and implement these ideas if they weren't thinking about it, if they were just focusing on other things that they might have had developed. So this is more of the thought process that we apply when we were doing our own analysis on this business, okay? So I hope this gives you a better understanding on how you could first start by looking at the company's financials, like we did here for Symmetrics and also TJ Maxx, but understanding capital structure, understanding how the market is pricing their business from a multiple standpoint, and also being able to tell the story about a business so that the CEO and other senior or the people part of the senior management team can understand that, because many of them perhaps don't have a background in finance or in investment banking. So it's the job of managing directors to cultivate those relationships and help them understand this whole process so that they can achieve their execution plan and continue to grow their business. So this is all part of that process. And my main goal here is that you can understand this and you can formulate your own thoughts so that you begin to do it on your own right after this lecture. And it improves at a deeper level what the role of a senior banker is, what are bankers involved in, and how you can put together a product, which is this. The presentation is the overall product, but also back it up with the technical analysis that it requires you to do all of this analysis on a pro forma level that can solidify your conclusion and your advice to the business. All right, folks? So I hope this process is clear. I hope you have a better understanding and perhaps at a deeper level what all of this really portrays and deals with. So with that being said, I guess I'll transfer it over to you and see if anyone has any questions. If you have any issues or something wasn't unclear, now is the opportunity for you to ask questions and give me the opportunity to clarify and answer them. So are there any questions from those right now? We see someone raising their hand. How can we get this part over here? Yep, okay. So the first question, do these sales and trading staff stay on trading platforms determining stock price each day? That's an interesting question. Well, yes and no. Let's go back here to investment banking, right? Yes and no, right? Because they have their core mandate, their core responsibility. And one of those core responsibilities could be to buy large blocks of shares for institutional clients. It could be for a hedge fund. It could be for a pension fund that wants to buy 1 million shares on TJ Maxx. Do you think they're gonna go in the open market and just execute 1 million shares? Probably not, because if they do that, they're gonna increase the price of the stock, which will also increase their average purchase price. So what they'll do is they'll sit back, they'll watch the stock, and they'll see technical levels where they can enter and lower their entry price. They can also communicate with other traders and see if there's anyone available on the street that may want to take large blocks of those shares, and they're gaining a commission, and they might also be able to get a small profit as well. So that's more of what they're doing with that process. It's a little bit more complex and technical than just sitting all day looking at the screen and buying and selling shares from a proprietary standpoint on their own book than what you might see someone else that is an independent trader. It's a little bit more complex than that. So I hope that answers that question. Here's another question. Do you think there's more advisory in investment banking than in sales and trading, especially at the analyst level? Now, what do you mean by there's more advisory in investment banking than in sales and trading? Well, the way I'm interpreting your question, there is a lot of advisory going on in investment banking, but also in sales and trading. If you are a sales trader has relationships with buy-side clients. These clients may include hedge funds, pension fund managers, high net worth individuals, where the research team would have a rating on a stock. The sales trader would share that opinion, even his own opinion as well, with all of his clients on the buy side. And if the buy side want to buy the stock based on the idea of the analyst or even that sales trader, they would flow those orders through the sales trader, and he will flow those orders through his own execution trading desk so that they can get a commission on that. So in a way, they are pitching ideas. They are advising their buy side clients on buying and selling shares to generate profit. So they have to be profitable investment ideas. Within investment banking, it's totally different, because within investment banking, you are giving advice to the CEO, the senior level management team at corporations on how to grow and expand their business. How do they finance their operations, their expansion, or mergers and acquisitions? So two different sides of the spectrum here, where they're both providing advice, but the advice is a little bit different, sales and trading, than from investment banking, right? One is more corporate finance related. The other one focuses more on creating profitable ideas for buying and selling stocks. It is more dealing with capital market. So I hope that gives you clarity on your question. I see another question here. Do the sales and trading staff stay on trading platform determining stock? No, that was the first one. Let me continue down here. Will you be sharing these slides up? So this is going to be uploaded on our YouTube channel. You can come back, you can watch it, you can take screenshots if you like, and you can create your own PowerPoint, right? We're not going to share our deck, but you can definitely take screenshot. And actually, to improve your presentation skills, this is actually one of the things that we do in our analyst program. We have our analysts recreate all of the presentations from scratch, because one of the skills that you learn as an analyst is soft skills, is presentation skills. So for you to improve your skills, go ahead and recreate this. I'm not just going to give you the presentation, because I want you to learn how to put these presentations together. And what you will learn is, as you're doing it, your muscle memory is working, and you would tend to retain the information longer, and you would also remember it more. So this is why I don't like sharing presentations. I put the content out there, but it's your job to watch it, recreate it yourself, which you would really perhaps remember it and understand it at a deeper level. Okay. And I think we have one more question here. Felix, hey Luis, thanks for putting it. Okay, will you be sharing? Same thing, Felix. We're gonna be sharing the video, not the presentation. Again, I want you guys to perhaps recreate all of this from scratch, because you'll learn it more, right? It's not, or if you take a screenshot, put it in PowerPoint, print it out, and then you have the deck. And then you can go slide by slide. You can mark it to help you better understand this information. And maybe you could replay the lecture and listen to my explanation again so that, again, you can retain the information and give you a deeper understanding. These were the things, folks, that I wish I understood and knew when I was a freshman in college, when I first set out to start perhaps a career and learn more about finance, right? These are things that took me a long time to understand and then be able to organize the information and make sense of it all. So a lot of this stuff right here, for those of you that are freshmen and sophomores, or even still at the undergraduate level, this would accelerate your understanding of corporate finance and what the world of Wall Street is really about when you break it down like this. All right? Great, you're welcome. All right, folks, so there's no other questions. I hope this was valuable. I hope you learned something, but most importantly, you can begin to provide your own advisory thesis, right? Come up with your own advisory cases just by looking at publicly traded companies and help you be better prepared for upcoming interviews that you might have. All right? So with that being said, folks, I'll end the session here. Take care, stay healthy, and I'll see you in the next one. Take care.